Hey everyone, so today I'm going to be talking about home ownership, financing. It's one of the most common questions I get from folks, probably because your home is often your biggest asset. So first, how do I feel about home ownership? Personally, I love home ownership. I think that it is a great way to have pride in something that you're working in. It's very healthy leverage. I mean, you can get a home that's within your budget, put 20% down, over the next 10, 15, 20 years. If you've bought it right, you can build up a ton of equity. So personally, I love home ownership. I think it's a great way for folks who are just normal people to build up a lot of equity over time. The question I've been getting a lot recently is in regards to refinancing, especially with the Federal Reserve just cutting rates. I think that's going to be a very common question over the next few months. And it really comes down to the financial nuts and bolts. So at the end of the day, if you can refinance, the rule of thumb is usually if you can drop your interest rate by 0.75%, it's probably worth at least exploring it with your mortgage provider. So a couple things to note. So if you're going to be moving anytime soon, you really probably want to avoid a refinancing. There's tons of closing costs. Usually if you can pay back your closing costs within 6 to 12 months of saved payments, that's probably going to make sense. If you're moving in 2 years and your break even is in 2 years, it's probably not worth refinancing. One thing to think about, if you bought a house in 2022, 2023, 2024, and your interest rate is a little bit higher, it's worthwhile to go to your mortgage provider that wrote your mortgage the first time. They might be able to offer you a credit so that you can close on your home, refinance it very quickly, and have very minimal expense and still save some good percentages on interest rates. So I get asked this a lot as well. Should I pay off my mortgage? This is a really common question. It's on the front of folks' minds. It's oftentimes the biggest debt anybody will have. And at the end of the day, it's a personal preference. I look at things very financially. If I can borrow against my house at 3%, do I really want to go pay that off if US government debt is paying me 5%? My answer is probably not. There's definitely an emotional element there though. A lot of folks, especially as they get near to retirement, they just like the feeling of having no debt. So there's not a right answer, but what I always tell folks is at least know the numbers. Know what you're giving up in opportunity cost by paying off your mortgage. If your mortgage is under 5% and you're making 6 to 8% on your investments, it is definitely a balancing act. I would really consider it very closely before I refinance. So the next question I get is a 15 or 30-year mortgage, which is better? Again, it's always going to be very unique to the individual. Personally, the expense and the hassle getting your mortgage done is great enough that I want to give myself as much flexibility as I can in my mortgage. What I mean by that is if ever you decide a 15-year mortgage is for you, if circumstances change in a couple of years and maybe that payment becomes a little bit tighter, you're going to have to refinance to a 30-year and the rates might be higher, the expense is too high. So what I strongly prefer is picking that 30-year mortgage, and if you want to pay more, pay more. Pay $500 extra a month. Turn that 30-year into a 15-year. Yeah, you give up a little bit on interest rate, but I think it's still well worthwhile for the extra flexibility. The next topic I get, and this one is really, really important, it's ARM loan or fixed income loan or fixed rate loan. ARM stands for adjustable rate mortgage. So personally, I do not like the ideas of adjustable rate mortgages. Last year I was buying my house. I thought through the fact that I could save a good amount of money up front by having an adjustable rate mortgage. I was supremely confident that rates were going to be moving lower over the next 12 and 24 months. And yet I picked the fixed income or the fixed rate mortgage. The reason I did that is because I know I can afford my house today. I know that for the next 30 years, my rate will not go up, and I have a free option to refinance later at a lower rate if needed. An adjustable rate mortgage can get you in a lot of trouble if you're already cutting things close to the margin and rates go up for whatever reason. You can be pushed out of your house, and that to me was not worth the extra savings on an adjustable rate mortgage to a fixed rate mortgage.